Let's assume that you want to buy this beautiful $400,000 house. So I'm gonna draw you right here, gotta give you a nice mustache. So you wanna buy this $400,000 house, and let's assume the interest rates are 3% a year and you get a 30-year fixed rate mortgage. If you do that, this house is gonna cost you $1,300 a month for your mortgage. If across the street this exact same home was listed for rent, it would be renting for $2,500 a month. It's going to cost you $1,300 a month to buy this house and $2,500 a month to rent this house. If you look at just these numbers alone, you would say obviously it is cheaper to buy this home, but it's really not so simple because you forgot to look at 5 different factors. You forgot to look at property taxes, maintenance, the cost of capital, your personal income taxes, and what I call your 10-year plan. Let's start with number 1. Property taxes. When you rent your home, you're not paying property taxes. It's included in your rent. When you buy your home, property taxes are separate. A simple rule of thumb is you can assume that property taxes will be 1% of your total home's value. So $4,000 a year, which adds up to $333 a month for property taxes. Just so you know, this 1% rule for property taxes is just a rule of thumb. It could be more or less depending on where you live, but it gives us a good idea for this example. Second, let's take a look at maintenance, because when you rent your home and you break your toilet because you ate, you can fill in the blank, your landlord is the one that has to come and pay the bill to fix your toilet. When your roof gets old, your landlord has to fix it. When your furnace gets old, your landlord is the one who has to pay the bill. When you own your home, you're responsible for all the repairs, upgrades, and maintenance. Like every 20-25 years, you might have to put on a new roof that might cost you $25,000. Every 20 years, you might have to put in a $5,000 furnace. Every 15 years, you might have to put in a $4,000 AC, plus kitchen remodels, plus bathroom repairs, plus windows. Add that all up and you can add in another $350 a month for maintenance and repairs, assuming you're not doing major upgrades to the property. Now, this doesn't mean that every single month you're going to have $350 going out to do maintenance on the property, but over the long run, owning the home, you can kind of estimate about $350 a month for a house this size. Third, you have to look at the opportunity cost or the cost of capital, because when you bought this home, you had to put 20% down, which is $80,000 on a $400,000 home. If you don't have $80,000 to buy this home, then you're going to be paying PMI. I'll get to affordability for homes a little bit later in this video, but you put $80,000 down to buy this home, and the $80,000 is money that you could have put into the stock market. It's money you could have invested into a business. It's money you could have used to buy an investment property, but you used it to buy your dream home. So there's an opportunity cost that you have to weigh. Think of it this way. Let's assume you have $1,000 in your pocket, and there are only 2 things that you can do with this $1,000. You can go to the store and buy a really nice scarf, or you can invest this $1,000, and in 2 years, this $1,000 will be worth $2,000. So if you go and buy the scarf, not only are you losing the $1,000 that you have to spend for the scarf, but you're also losing the opportunity to make that extra $1,000. So you're actually losing out on $2,000 because it's the cost of the scarf, the $1,000, and it's the $1,000 opportunity that you lost. It's the same with your home. You had $80,000 in your bank account, and now that you use it to buy this home, you can't use that $80,000 to invest in the stock market. And let's assume that you can get a 5% return on your money in the stock market. Now, the average return in the stock market is between 7 and 10% a year, but I'm being conservative. If you can get a 5% return a year on your stock market, that means you're losing out on the opportunity to make something like $4,000 a year. So the opportunity cost of you taking this $80,000 and putting it into this home, as opposed to taking this $80,000 and putting it into the stock market, where you would make $4,000 a year, which is another $333 a month, is the opportunity cost you are losing of $333 a month, because if you put this money into the stock market instead of your home, you'd be making an additional $333 a month. At this point, many of you are probably thinking, but Jaspreet, that's not a fair analysis. The value of your home is going to go up too, because your home is an investment and real estate never goes down in value. Now, I get it. I'm a real estate investor. I have purchased properties that have doubled or tripled in value in a very short amount of time. So if your property goes up by 4% a year, then this $333 a month that you're losing in opportunity cost is recovered through appreciation in your home. But it's really hard to calculate that because you're not buying this home for the sole purpose of making money. You are buying this home as a place to live, not as an investment. You're buying this home to live in and use. You're not buying it to flip. Can you make money on your home? Yeah, absolutely. But remember, you're not buying this home to get rich. You're buying this home to use it. If you were buying this property just to make money, then it would be better for you to go out and buy an investment property. That way you can get passive income and the appreciation instead of buying a home to live in. You could very well see that 4% appreciation in the home value of your home, but you don't actually realize or get that money until you sell your home and sell the place where you live. Most people are not buying their home thinking, okay, I'm going to move into this home, and as soon as my property value goes up by 20%, I'm going to sell this home and move somewhere else. If you do, then you can just ignore everything I'm saying, but most people don't. Most people are buying their home thinking, I want to live here, that way I can raise my family and settle down and make memories. That way they can live in this home and enjoy it for as long as possible, and then they're going to sell when they absolutely need to sell or if something comes up. So when it comes time for you to sell, you're at the mercy of the real estate market. You're not selling because you think, oh, property values have gone up, let me sell my home and move somewhere else. If home values are up when it comes time for you to sell, then you're golden. If home values are not up, then that appreciation is not there. Remember, if the 2008 recession taught us anything, it's that real estate doesn't always go up in value. Fourth is your personal income taxes, because when you own your home, you actually get a deduction on the interest you pay on your mortgage. So unlike these three, this interest deduction actually makes the cost of home ownership a little bit cheaper, because every single month when you're paying this $1,300, some of this money is going into your bank's pocket as profit through interest, while the other money is principal, which goes towards your loan value. Banks are smart and they want to get paid before you do. And what they do is they front load your loans. So out of this $1,300 that you're paying during the first few years of your loan, almost all of this $1,300 is going into your bank's pocket as interest, and very little of this money is going towards your loan principal. Towards the end of your mortgage is flipped, because now almost all of your money is going towards the principal value of your home because you paid the bank during the first years of your loan. So during the end of the mortgage is when you're actually getting the real benefit and building equity in your home, and the beginning parts of your mortgage is when your bank is making all the money. What that means is a portion of this $1,300 that you're paying every single month is going to be deducted from your personal income taxes. Now, the amount of benefit that you have from this income tax deduction is going to depend on your tax bracket. The higher your tax bracket, the more valuable your deduction is. In other words, the more money you make, the more valuable this deduction is, and you're going to get a bigger deduction in the first half of your loan than you're going to see in the second half of your loan. So to keep things simple, let's assume that this interest deduction lets you keep an additional $200 a month in your pocket. So based off of these numbers, if we add this up, it looks like the total cost for you to own your home is actually closer to $2,116 a month. So based off of these numbers and compared to this rent payment, which can vary based on your area, it looks like based off of these numbers, it is cheaper to own this home based off of these numbers compared to this rent. But we're still not done yet. Before we get into whether you can actually afford to buy your home, let's talk about number 5, your 10-year plan. Because as somebody who is a real estate investor, and as somebody who used to work actively as a real estate salesperson, I can tell you that buying and selling your own home is a big deal. This isn't something that you're just gonna do in your free time when you feel like it. When we're talking about buying or selling your dream home for your family, it is always on your mind. You're always looking at home prices. You're always thinking about mortgages. You're always thinking about how you're gonna move your property. Owning your home takes work. It's time intensive and it locks you down. It's not something you can just leave with a snap of a finger. If you plan on living in this home for 10 years, then it's no big deal. But if you're not sure if you're committed to the area where you're buying, or if you're not sure if you're even going to be there in 6 months or a year, is it really worth all that headache to buy a home when you might be moving out in just a few months and you have to sell this property again? When you rent a property, you're not tied down. You can just break your lease and move if you really needed to. When you're leasing, you have the flexibility to live in new communities and try different homes and see what you really like and where you want to live. It's hard to put a dollar figure on this 10-year plan, but it is definitely something you want to consider because there's a lot of time involved and there's a lot of brain power involved when it comes to moving out of a home that you own as opposed to a home that you rent. So based off of these numbers and these mortgage rates and this down payment, it is cheaper for you to buy this home than it would be for you to rent this home. But if the going rental rate for this same property was $2,000 a month as opposed to $2,500 a month, then it would be cheaper for you to rent this home than buy the home, which is why you need to do the numbers. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.